And basically they can exchange securities of an ETF in kind. So that means when a redemption occurs, the ETF can distribute securities instead of selling them, potentially avoiding capital gains taxes. So that's simply the buying and selling inside the fund itself. With mutual funds, if they buy and sell a stock inside the mutual fund, it's going to create either a gain or a loss on that stock, and that gets transferred to you at the end of the year through capital gains. And so you'll receive a 1099 showing the capital gain distributions on that fund. And so if they were holding a lot of highly appreciable assets and they had to get rid of those assets, it could produce a very large capital gain for you at the end, and you have to pay taxes on that if this is not held inside a qualified account, such as a 401k or an IRA, where you're kind of in that little tax bubble, right? You don't have to worry about that. So it's very important, especially when we're dealing with non-qualified assets. So when we're talking about assets that are not inside that retirement bubble, it produces what they call tax drag. And so tax drag can reduce the performance of your fund. So if we have two funds with identical performance, say that this mutual fund has an 8% performance,